FA2 Key Terms. Part B. Advanced Accounting Procedures. Chapter 5. Accounting Concepts and Principles. Basic Accounting Principles and Concepts. Basic accounting principles and concept are the broad assumptions which underline the periodic financial accounts of business entities. Business entity concept. The business entity concept, a business, for accounting purposes, is a separate entity from its owners or managers. We looked at this in Chapter 1. Double entry bookkeeping. Double entry bookkeeping, introduced in Chapter 1 and covered in detail in Chapter 4, is the system of accounting which reflects the fact that every financial transaction affects the entity in two ways and gives rise to two accounting entries, one a debit and the other a credit. The total value of debit entries is therefore always equal at any time to the total value of credit entries. Going concern. The going concern assumption implies that the business will continue in operation for the foreseeable future, and that there is no intention to put the company into liquidation or to make drastic cutbacks to the scale of operations. The money measurement concept. The money measurement concept states, accounts only deal with items to which a monetary value can be attributed. The separate valuation principle. The separate valuation principle states, each component part of an asset or liability on the statement of financial position must be valued separately. Accruals. The accruals basis requires that the impacts of transactions and other events are recognized when they occur, and not as cash is received or paid. Transactions should be recorded in the accounting records and reported in the period to which they relate. Expenses are recognized in the income statement on the basis of a direct association between costs incurred and the earning of specific items from income. The expenditure incurred in earning the profit for an accounting period is matched to that profit. For this reason the accruals basis is sometimes referred to as the matching concept. Prudence. Prudence states the inclusion of a degree of caution in the exercise of the judgments needed in making the estimates required under conditions of uncertainty, such that assets or income are not overstated and liabilities or expenses are not understated. Consistency. Consistency requires that similar items should be accorded similar accounting treatment. Materiality concept. Under the materiality concept only material items should appear in the financial statements. Items are material if their omission would influence the economic decisions of users based on the financial statements. Historical cost. Using historical cost has a number of implications. Transactions are stated at their value when they occurred. This means, for example, that the cost of goods sold is not suddenly increased at the end of the year. Assets are stated at their historical cost. In other words, the value of an asset in a statement of financial position is based on the price that was paid for it. Accounting policies. Accounting policies are the specific principles, bases, conventions, rules and practices adopted by an entity in preparing and presenting financial statements.